I know inflation was never really a big issue for China. It's really more about the growth dynamics that we're seeing, whether it's with this Omicron infections that have now made it to the mainland. Is there a big risk right now that China could actually slow much more than expected?
Good morning, Yvonne and David. The reading on CPI indicate that there's no inflation pressure in China at all, and China and the U.S. are in a completely different phase of the cycle. Regarding the risk, I think that if you asked me this question, say months ago, I would say the risk will be a major policy mistake because Chinese authority have been embarking on a tightening stance for March of last year. But since about a month ago, there has been a clear policy shift and toward from last year's tightening to easing on all important fronts, including monetary, fiscal, housing, and regulatory measures. So with those policy changes, I would say the downside risk to China's growth outlook is rather small at this moment.
So, and you're looking a little bit more bullish when it comes to Chinese assets. Just walk us through how you try to shape some sort of portfolio now for the year.
Well, we are more bullish on the market outlook now than 3 months ago because there were 3 salient factors that contributed to the poor performance of Chinese market last year. One is just as I mentioned that the tight policy stance and fiscal, monetary, and regulatory measures. And second one was the regulatory measures targeting specific industries like platform tech companies and healthcare industries. And third one being the CPI inflation wedge, create cost pressure on the mid downstream industries. But all 3 factors will change in the coming year. First, there is a overall macro policy shift we just discussed. Second, I think it's more important is that I believe the most severe phase of the shock from the regulatory measures to those target industries has come to a new equilibrium. By that, I mean that I think the regulatory environment starts normalizing, and that's the shock to those sectors or companies affected. The worst part is over. So that's why we start to looking at them and finding opportunities to rebuild positions. The third one being that related to the data release today, that is the PPI inflation coming down and the CPI inflation is stable. So the wedge between PPI and CPI inflation is narrowing. That will ease the cost pressure for the mid downstream industries. Again, it has important implications for equity investment.
So the assumption is, and many people also have told us this reversion to the mean this year, because last year was just such a bad year for Chinese equities. What are your expectations on A-share market returns for this year? And would that easily be a hurdle for you guys to outperform also?
Well, we think it's first because the policy cycles between China and U.S. will reverse. So the fortune of the market performance between China and U.S. will likely also reverse. So we are more bullish now, and we are more bullish on A shares and slightly more so than H shares because the liquid conditions onshore will be slightly better than the offshore conditions, and that's why we are bullish on both Hong Kong, China, but on the margin we are more bullish on Chinese A shares.
People talk about a catalyst, Wang Qing. And it's clearly not just cheap valuations. Otherwise, this market would have rallied as early as 6 months ago. I'm wondering how you would describe sentiment on the ground, because it's been a while, and you know this more than I do, where equity markets, one, and the housing market, two, have not done very well. And those are two very big parts of the household portfolio of many Chinese families and households. How would you describe sentiment on the ground right now, given those two realities?
Believe it or not, the sentiment for China investor remain quite good. If you look at the trading volume on in the exchanges in China, it had been record high this last year. Our key reason is that because of the Chinese authorities' crackdown on property investment, that leave not many opportunities for Chinese investor to put their money in, making equity market one of the few opportunities where they can put their money in. That's why you see a flush of liquidity in the onshore equity market, despite the overall tight macroeconomic conditions.
And I'm just wondering, in terms of, how this pivot that you're seeing from the PBOC, as you mentioned, from the policy crackdowns that we saw in 2021. I'm just wondering, how significant is this shift now in relation to how the tightening that we saw last year, and how far will they go? I mean, there's calls now that they might actually have to do interest rate cuts. What's your take?
Oh yeah, the shift is very significant. I think it has been not fully appreciated by many market observers, because for 2022, the Chinese authority make maintaining stability become their top priority. More importantly, they are making the economic development as a central task, quote unquote, and calling on all levels of governments to take responsibility to stabilize the macroeconomy. I think the unfolding policy easing will likely overshoot rather than underwhelm. In fact, even though China's latest money and credit numbers are still weak, but if you look at some second-order indicators like credit impulse, already start to improve quite markedly.
So as a final question, when do you expect the economy to bottom, and what do you think is the baseline growth for the economy this year? Just to answer the question asked by Yvonne from last one, is that we do expect more policy easing on the monetary policy front, including interest rate cut and the cut in reserve required ratios. And given the turning of policy cycle, we expect the economy, all the earnings cycle will start to bottom out as early as the second quarter, as late as mid this year. So this is why we tend to believe that right now could be the bottom range for the Chinese equity market, be it A shares or H shares.